So acknowledgement of country first. And of course the tax clinic is there to improve the knowledge of the community, and we're part of 10 tax clinics at universities throughout Australia. So what I wanted to start with was the basic tax formula, because I think this should help to explain why certain items are deductible, certain items of expenses aren't deductible, but also it puts into context what is your assessable income. So if you're a sole trader, in other words, you're an individual, and you receive income from a whole range of sources, such as dividends or interest from your bank account, working as an employee for an employer, or in fact being a sole trader, being a contractor, as it were. But all of those various amounts of money are all forming part of your assessable income. And then, of course, we deduct our expenses. And those are expenses that are connected to us earning our income. And they're called allowable deductions. And in the second part of this presentation, I'll deal with, well, most of the deductions that relate to virtually all of us. Now, once we've deducted those expenses, we end up with our taxable income. And it's that taxable income that we apply the marginal rates of tax, which you'll see on the next slide. And we add Medicare levy of 2%. And obviously, if you had a debt, an education debt, either to a vocational education debt or a university debt, you also repay that because it's added on to your taxable income. After you've calculated how much tax you pay, tax payable, you're then entitled to reduce that amount by tax offsets. Now, if you've worked as an employee and your employer has deducted tax from your salary, then you will have a credit. You will have a pay-as-you-go withholding amount, which is basically your tax being paid in advance, or you're paying tax in advance under the pay-as-you-go instalment system. And I'll talk about that a bit more shortly. That gives you your net tax payable, and you have 28 days from the date of your notice of assessment to pay the tax. Or if you've been paying tax under the pay-as-you-go instalment system, then you will have already paid tax. Now, down the bottom of this slide, I've got note self-assessment. What happens in Australia, we have a self-assessment regime. What that means is that the tax office trusts you to make your own accurate and honest assessment of how much tax you have to pay. So when you claim deductions, you're not providing the tax office with copies of receipts. The tax office is trusting you. Now, the downside of that is that if at some later time, particularly it has to be within 2 years, the tax office questions you about your deductions, you need to provide then evidence of your deductions. If you fail to do that, then the tax office can impose interest on tax that should have been paid, and they can also impose penalties, which can be, in some cases, up to 100% of the tax that should have been paid. So that's self-assessment. So when you ask the question, can I claim the cost of buying cleaning materials due to COVID-19 because I have to clean my car? Well, under self-assessment, you make that assessment. Yes, that expense is related to you earning your assessable income. Yes, you're entitled to claim a deduction. Now, different structures. This is really for those people who want to establish a business or are in business. We basically have 4 different types of structures. Sole trader, which is basically you and I, the individual. We could form a partnership, but if we form a partnership, we must apply for a separate tax file number for the partnership, and we have to lodge a partnership tax return. So the partnership tax return would in turn show that the individual partners have received income or losses from the partnership, and then you include that again in your own individual tax return. So the downside for a partnership is you must have a separate tax file number, you must have a separate ABN, Australian Business Number, and you must lodge a tax return. Similarly with a trust. With a trust, again, you must have a separate tax file number, you must have an ABN, and you must lodge a tax return, and basically it's the beneficiaries of the trust who pay tax. Now again, with trusts, the beneficiaries have protection from liability because the assets are tied up in the trust. Company being the 4th type of structure, again, must have a separate tax file number. It lodges a tax return and it does pay tax. So the only 3 entities in Australia that pay tax are individuals, companies, and superannuation funds. Now the company tax rate for base rate entities or small companies will be 26%, starting from starting from 1 July. But thing to keep in mind is that if you start off as a sole trader and you find that you're getting bigger or you want to look at some sort of liability protection, or you want to employ people and it's easier to do it in a company, or you have a range of shareholders, then you can simply roll all of the assets that you own as a sole trader into the company and you don't create a capital gains tax liability. Now, trading as a sole trader, yes, it's a great way to go if you're starting out with business. Less expensive because you can generally do the accounting and bookkeeping by yourself. You only lodge one tax return and you use your own tax file number. And again, you as a sole trader could employ people, but if you employ staff, then you need to be aware of paying tax on their behalf under the PAYG withholding system and superannuation payments. Now, how do you set everything up? Well, most individuals have their own tax file number. If you don't, if you're new to Australia, then you need to apply for your tax file number. Once you have that, you then apply for an Australian business number, but you need your tax file number first. It's always a good idea to have a separate bank account for your business. Now, what that does for you is it actually keeps your records. So if that is a separate bank account for your business as an NDIS disability support worker, all of the money you earn from that particular business goes into the bank account. Then when you start paying for expenses, that money comes out of that bank account. So in effect, your bank statements are a good source of records of your accounts. But you also need to keep better records and more specific records of certain expenses. Now, again, depending on the type of business, you may need to be registered, you may need certain licenses. You may well want to have some public liability insurance to at least protect you from liability. So if you were setting up a food van, for instance, you would need to be registered with the local council in relation to food handling. For NDIS, disability support workers, you don't necessarily need to be registered, but you can. You do. It's encouraged that you have some insurance. So these are all the basic things when you go to set up your business. Now, do you need to apply for a business name? Well, you don't if you're using your own name. But if you were to set up a business called ABC Services Hobart, then you would need to register that name. And if anyone wanted to know who the owner of the business was, they could check the business name register and they would see that you are the owner. But otherwise, you don't need to register the business name. Now, do you need to register for GST? Well, it really depends. To start with, if your turnover, if you're going to invoice your services and they are going to exceed $75,000 for a financial year, you need to be registered for GST. Now, one of the things that you would be aware of if you're in the NDIS area, that the services you provide to NDIS clients who have a registered plan, the services you provide are GST free, which means that you're not collecting GST for the work you do in the NDIS area. But you're also paying GST. So if you bought a computer for $1,100, you would divide 1,100 by 11 and you would end up with $100 of GST that you've paid for. But if you were registered and you were using that computer 100% for business purposes, you would be able to claim the GST back. Now, a couple of things to keep in mind. If you're not registered for GST and you do disability support work, if you find that you get to the end of the year and you've invoiced for your services $80,000 worth, then you're going to need to register retrospectively, and even though you're not collecting GST, you would be able to claim the GST back that you've paid for. But if not only were you doing NDIS disability support work, but let's say you provided some other services where GST was paid, then again you would need to be registered because you've exceeded the 75,000 mark. Now, so let's I mean, this is getting more complicated, and if need be, we can talk in more detail about GST, but let's just assume that you're not going to be registered, and that way you don't have to lodge 4 business activity statements during the year, And the business activity statements basically ask you to tell the tax office what the amount of your services were, if there was GST included, if there was, how much GST you've collected, and then the tax office wants to know how much you've paid for your inputs into your business, and if there was GST included in that, how much GST you've paid, and then you net one against the other, and you either pay GST or you get a refund. Now, GST is totally separate from income tax. So it doesn't affect your income tax position to any great extent. But look, I'll leave it at that because, again, I don't want to complicate things too much. Now, pay-as-you-go instalments. Again, this is important for you because in your first year when you set up your business, and it is a business, it's you as a sole trader providing services to the NDIS clients, they're going to pay you and you won't be paying any income tax until such time as you lodge your first tax return. Once you lodge your first tax return, and let's say your total assessable income, or not assessable, your taxable income was 50,000, and you had to pay, I'm just guessing here, but probably about $7,000 in income tax, plus 2% Medicare levy, so that would be another $1,000, and you would pay that tax. And then very shortly after that, the tax office would write to you and say, we've now calculated your instalment rate at a particular percentage, and we require you to pay an instalment of income tax every 3 months based on you multiplying your instalment rate by the total sales that you made of your services during that 3 months period. Now, basically what that does is it means that by the time you then get to the 30th of June, you've already paid tax as you go through the year. But it's important that you understand this because where in the first year you don't have any tax to worry about, and if you put money aside, which is always wise to pay tax, you pay it. But then the second year, the PAYG instalment system will operate and you will be required to pay tax every 3 months. So hopefully that makes sense. For those of you that have been working for more than 12 months, this will be something that you're doing now. But for those that are just starting out, it's something to keep in mind. So you can't think, oh, well, every year I don't have to worry about tax until I get to the end of the financial year and lodge my tax return. It doesn't work like that. Now, what should you include in a tax invoice if you're registered for GST? Or if you're not registered for GST, you don't need to use the word tax invoice. But normally you would put your name, your ABN, your address, your contact details, and then you would simply put to services rendered, and that's the amount that you would include in your invoice. Now, do you need to lodge a tax return? If you're a sole trader, and what that means is that you're not an employee, but you're a sole trader, you're a contractor, and you may have other income or you may not, you must lodge a tax return, even if it's less than $18,200. Similarly, if you've received any Centrelink benefits, you must lodge a tax return. because the ATO now shares information with Centrelink. And so in your tax return, you would look at your income, and your income, as I say, includes income from all sources that you have. All of that is grouped together as your assessable income. So that would include if Centrelink benefits, if they were paid to you, your work as an NDIS disability support worker under your ABN, and then if you did some work as an employee, that would also be included in your assessable income. And then you would look at deductions. You would look at expenses that you've incurred in earning all of those different sources of income. And then you complete your tax return, you click the button calculate, and the ATO will determine how much tax you need to pay, or the system does. And it also includes any amount under the small business income tax offset. And I'll talk a little bit more about that shortly. Now, these are the tax rates. Again, they're fairly obvious. And they're important to keep in mind because let's say your income was $90,000. Now you can see there that the tax rate from $90,000 onwards to 180 is 37%. But you would also include 2% Medicare levy, and that takes you up to 39%. Now, again, it's important. If you spent $100 to buy some materials to be used in your business, the cost of that $100 equals basically $39 back in tax savings. But you don't get it back. What that means is that instead of paying $39 on that $100 extra, you're not including it in your assessable income, but basically it's worth $39 back to you in tax savings. It doesn't mean that it's $39 of tax that you don't pay. It simply is an amount that you reduce your taxable income by. So for instance, if your tax rate is 19%, let's say you're paying Medicare levy of 2%, it's 21%, then basically for every dollar you spend, that is an expense that's deductible, you're basically saving 21 cents of it in terms of tax. Now, do you have to pay superannuation? Only if you employ staff do you have to pay superannuation. And at the moment it's 9.5% of the salary. But if you're a sole trader and you make contributions to a superannuation fund, you can claim a deduction for the amount that you've paid. Now, as the slide says here, you need to notify your superannuation fund that you wish to claim a deduction. You pay them the money and they will, in fact, confirm that you're entitled to claim the amount as a personal deduction. Now, what that means is, at any time, if you've never been a member of a superannuation fund, a retirement fund, it's very simple. You go online or you visit, well, these days you go online, you look up various superannuation funds, and there's one fund that doesn't charge fees, but it doesn't provide very much of a return. But there is a whole range of funds that you can join, and all it is simply going online, providing your personal details, your tax file number, and then becoming a member of that fund. So, for instance, if you got to the 30th of June or the 29th of June, or maybe a bit before that, you had some surplus money, you wanted to claim a deduction for it, and you wanted to make provision for your retirement, you can pay that into your fund and receive a tax deduction. There are also other benefits in terms of spouse contribution offsets, but again, that's taking us into a slightly more complicated area. Now, do you need insurance cover? Well, if you use one of the platforms as an NDIS disability support worker, the platform will provide public liability insurance for you. But normally you would buy motor vehicle insurance, you would buy professional indemnity insurance is covered. Workers' compensation only applies if you have employees, but you might take out some trauma insurance or some life insurance, and those premiums are not deductible to you. And that's because something happens to you and the money is paid, it's not subject to tax, it's not assessable income. So again, insurance, something to keep in mind. Now, if you have employees, then you do need to use some software to do your payroll under the single touch payroll system. And that includes you paying their PAYG withholding tax and any superannuation. Now, what are the expenses? Well, clearly, if you don't use a particular item 100% for business purposes, you're not entitled to claim 100% of the cost. So the example here is you purchase a laptop computer and you're claiming a depreciation deduction on it. But if you only use the laptop 50% for business, and again, under self-assessment, it's up to you to make that assessment. It's up to you to be honest and to base it on some logic that that's the amount of time that you use for business and the other 50% for personal use. And so apportionment becomes very important, not only with laptops, but with the use of your car, with the internet, with your mobile telephones, all of those things. It's up to you to make an honest assessment of how you apportion those costs. But, so we're going to talk about all of these types of expenses. Uniform laundry. Now, if you're required to wear specific clothing, it could be special clothing because of the nature of your industry, not just uniforms that your employer provides you with, but you may need special support shoes. You may need to have certain clothing for protection purposes. Then the cost of buying that clothing and keeping the clothing clean is a deduction for you. Your home office expense. Now remember, the ATO tax office came out with the special 80 cents per hour between the 1st of March till the 30th of June this year for those people that have to work from home because of the coronavirus. Now, If you don't use that, you can use the 52 cents an hour, and you're then entitled to claim a deduction for your internet use, your depreciation on your equipment, and your telephone. But the 52 cents an hour would cover things like electricity and rent or mortgage interest or all of those other deductions associated with you working from home. Now, obviously, if you're an NDIS disability support worker, your office is your home. So you need to be mindful of how you go about claiming your deduction for using part of your home as a deduction for business purposes. So 52 cents an hour if you want to. If you don't want to do that, then you would need to look at the area in your house that you use as your home office. You would need to look at the cost of electricity to keep it warm or cold, depending whether it's winter or summer. You would need to look at rent or interest on your mortgage. You would need to look at depreciation on your desk, on your electronic equipment, computers, printers, etc. Now, just remember that if you own your own home and you use part of it for a home office, then you may affect the capital gains tax exemption because it ceases to be your main residence. You're using part of it for business purposes. Now, other things like bank charges, yes, motor vehicle expenses, and I'm going to talk about that in a minute. Business travel, if you had to travel, yes, the cost of your airline ticket, etc. Education and training. Now, again with education, and I noticed this from the questions that were asked, you need to break education up into two parts. So to give you an example, if you went to university and you trained to be an accountant, you can't claim the cost of training to be an accountant as a tax deduction if you subsequently end up working as an accountant. But if while you're working as an accountant, you need to do further study to become a professional, a member of a professional accounting body, then that expense would be deductible. So again, if you need to do some initial training in order to qualify to be an NDIS disability support worker, that cost would not be deductible. Similarly, if you had to apply for a police check before you could even start work, that cost would not be deductible. But if when you're working in that industry, you need to do further education, then under self-education, that expense would be deductible. Professional memberships, yes, not a problem. Interest on a loan to buy a car that you use for business purposes or whatever, yes, it would be. Telephone, yes. Internet, again, depending on the amount. Repairs, maintenance, tax preparation costs, yes. Bad debts. Depreciation. So if you have items of plant and equipment, items that you buy that have an effective life of more than 1 year. So if we think about a laptop computer, unless we go out and buy a brand new one every year, we keep our laptop computers for 2 or 3 years. So you would claim depreciation as a deduction over the 2 or 3 years, and that would be your deduction until such time as the laptop then has a written down value of 0 and you go out and buy a new laptop computer. Similarly with your furniture, with your printer, with a whole range of other electrical items, you need to check with the ATO. They put out a ruling on the effective life of virtually everything we buy and use in business. But again, you need to think in terms of, am I using it 100% for business, or am I only using it 50% for business? Now, motor vehicles, this always is an important area, and one of the issues that's important is this current 150,000 instant write-off. Now, it only came into effect from the 12th of March and it finishes 31 December this year. And the government introduced it because it wants to encourage people to go out and spend money to buy new items of plant and equipment for their business, because it stimulates the economy and helps to boost employment, etc. So it applies for businesses with a turnover of less than 10 million. So that's okay. Although in this period, I think the limit's been increased to 50 million just for this short period. Now, let's use the example of you as a NDIS disability support worker. You have a motor car, you need to use it for work purposes for the business, but you also use it partly for private purposes. So I've tried to show here in a fairly easy way, and we're going to need to look at logbook requirements, and that comes up in about 2 slides' time. But you need to be aware of, well, there are 2 things that are important. If we're talking about a motor car, a normal passenger car that you drive, let's say a Toyota Camry. So you buy a Toyota Camry, it carries less than 9 people, well, you can usually only fit 5 people in it. It doesn't carry more than a ton of goods, therefore it's a passenger vehicle, therefore you're subject to the luxury car limit of $57,581. Now, what that means is that if you bought a car for $80,000 and it was a normal car, not a truck or a utility, and you calculated that your business usage was 70%, personal usage 30%, you would multiply the depreciation limit. Well, I think here in my example, I've said, let's say you bought it on the 15th of July, and that's when the luxury car limit number goes up to 59,136. So you would take 70% of 59,136 and you would be able to claim an instant deduction, instant asset write-off of 41,394, and the remaining amount up to 59,136 would be depreciated over the next 8 years, which is the effective life of a motor car. Now, a couple of things. If you were a tradesperson and you bought a utility or a small truck or van and it was being used 100% for work purposes, that luxury car limit doesn't apply. So if you bought a utility or a truck that can carry more than a ton in weight, then and you pay $80,000 for it, you get an instant deduction of that $80,000. Now, if there are two things to remember. If you had a car, well, let's say you had two cars. One car was strictly used for business only, and the other car was used for private purposes, and you only used the car for business purposes 100%, then you wouldn't need to keep a logbook. And I'll explain that in a second. And you would claim the whole 100% of the cost of that vehicle if it was under the luxury car limit. Now, logbook or running costs. I'll jump down to logbook. And this again is something that's very important for you to take into account. If you're using your car for business purposes, and you're probably going to travel more than 5,000 kilometres in the year, then you may want to, well, you really have no option but to keep a logbook, particularly if you want to claim the maximum deductions. So what that means is for a period of 12 weeks, every single day for 12 weeks continuously, you record what the kilometres are at the start of the day on your car, what the kilometres are at the end of the day. You also record what your trip was for. So if your car has 10,000 kilometres on it, tomorrow you drive 100 kilometres, 80 kilometres worth for work purposes, 20 kilometres worth for private purposes, and you did that for a period of 12 weeks. You then calculate what is the business percentage use and what is the private percentage, and that's what you apply to all of your expenses. So that would cover the fuel that you buy, it would cover registration, insurance, repairs and maintenance. It would cover depreciation. If you borrowed money to buy the car, it would cover the interest expense on it. If you didn't buy the car, but you leased the car, it would cover the lease payments. So logbook determines what is your business usage, what is your private usage. Obviously, if you had two cars, you would keep one strictly for business, and then you wouldn't need to keep a logbook. But if you only have the one car, then you need to apportion those expenses. However, if you're only using your car for, let's say, 3,000 kilometres in the year, then you simply multiply those kilometres by 68 cents, and that takes into account all of your expenses, your petrol, your registration, your insurance, your depreciation, your interest if you had it. All of those expenses are included in the 68 cents a kilometre, and all that you would need to do is keep a daily record of how many kilometres you travel for what particular purpose. But if you're going to buy a brand new car and you want to claim the instant asset write-off, then you would need to know your business or private percentage usage. Now, other deductions, well, I've tried to sort of list them there. And post office box rental. Well, yes, if you need your mail to go to a particular post office box, and that's to collect your business mail, then that would be deductible. Stationery that you would need. What else? Well, yep, working from home expenses I've talked about. Other expenses, yes, if you had to do additional training, those costs would be deductible. But just remember, when you do your tax return, these items are not listed out specifically. It would be self-education expenses. That would be the amount. Now, vehicle lease payments, yes, if you leased a car rather than buying it outright, the lease payments are deductible, but again in proportion to business or private usage. Travel costs, yes. Transporting a client, well, you probably would bill the client. Special disability support worker deductions. Yes, your blue card and your yellow card if you had to renew them, but if you need them initially to get the job, then they're not a deduction. First aid courses, yes, if you need to, if that's part of your requirement. Union membership, professional membership, yes. There is no question that those expenses are deductible. Now, medical equipment, other equipment that you buy, the legal client agreements to get some legal advice relating to that particular agreement, yes, it would be deductible. Registration, yes. Look, if you took your client out and you had to buy them a meal or some refreshments, yes, that's a necessary part of your business and it would be deductible for you. But you should keep a record in case at some stage the tax office wrote to you and said, can you please provide details of these expenses? But as I've said down the bottom, sometimes some of those expenses are included in the payment that you're provided with, either on an hourly basis or whatever. Now, using a platform, and this is where, again, the bottom line for you is that you end up with a certain amount of money, a net amount. So if you use a platform such as Mable and they charge your client $40 an hour, they take out $6 for their fees, for insurance, for other costs, and they then give you $34 an hour. You have basically two options. You could include in your assessable income the amount of $40 an hour and then claim the costs of using the platform $6, or you can simply include $34 as your assessable income and then not claim a deduction for the platform costs. Either way, you still end up in the same position. Now, coronavirus has created lots of additional expenses. Absolutely all of those cleaning products, all of the additional expenses, masks, etc., would be deductible to you because they are necessary items that you need to pay for in order to earn your assessable income. Now, losses, well, hopefully you don't make a loss, but if in the first year you had to buy a lot of equipment and you spent a lot of money, let's say you set up your business on the 1st of May and you had to buy lots of equipment, but you didn't receive very much income up till the 30th of June, then you might make a loss. That loss would then be a tax deduction for the following year. So losses from trading are a tax deduction. Now, additional questions. Yes, Centrelink benefits are available. Centrelink benefits are based on your income. So you could be receiving some Centrelink payments and you could also be working part-time as a disability support worker. The only thing to remember is that with Centrelink payments, it's based on a family unit, the family unit's income. And if you had a partner, well, the limit at which they can earn money has now been increased on a temporary basis to that $3,068. But yes, Centrelink benefits are assessable income. The only reason why people that are on Centrelink benefits don't pay tax is because the Centrelink benefits don't amount to more than $18,200, which is the tax-free threshold. Sole traders are eligible for JobKeeper and JobSeeker, and it was just a matter of claiming those amounts, putting in your claim to the tax office. Now, again, just with this slide, it doesn't matter where your income comes from. It's all grouped together as part of your assessable income. So you can be a sole trader working under your ABN, and at the same time, you could have casual work as an employee. The benefit of having the casual work as an employee is that the employer may well withhold some of your money and pay it to the tax office as pay-as-you-go withholding tax, which means that when you get to the end of the financial year, you don't have as much money to find to pay your tax. If you have a HECS debt or a fee help debt, then you do start paying that back. The threshold there starts at $46,620. What that means is that when you lodge your tax return and your income is all under your ABN as a sole trader, if you've earned, say, $54,000, then the system will calculate that you need to pay an extra 2% to repay your university debt. Superannuation I've talked about. It does provide you with a tax deduction, and that's the end of the presentation. And if I click on that, and not share, that should be the end. Or do we have any questions?
John, questions are in the Q&A symbol.
I missed what you said then.
The questions are at the bottom. If you click on that button, Q&A.
Q&A. I can't see where Q&A is. Oh, yes, I can. Yes, yep. Sorry, yes. Okay. Yes, in terms of the being the GST-free services, generally the client has to have a registered plan. So when you look at the tax office ruling on it, I think they use the word they must have a registered plan in order for the services to be GST free. Receiving income hourly is the income received personal services income or business income. Look, it's the same thing. Personal services income is in fact business income. The personal services income anti-avoidance test was, and it tends to lead to confusion. What it means is that if you were working one day as an employee and then you set up a company the next day and you contracted to that former employer, with the idea of being able to employ your spouse to create lots of tax deductions, so to reduce your tax, then that would be caught under the personal services income anti-avoidance measures. Now, what that means is that all of that income that's being earned by the company is then treated as being your own personal income, similar to being a sole trader. So what I'm saying here is when you look at the tax return and it says, is this personal services income? Well, it is, but it is business income. It's you in effect selling your time to clients. Does the write-off need to be a new vehicle? I'm not sure of that.
John, the second-hand vehicle is also acceptable.
Is second-hand acceptable?
Yeah, it is.
Yes, so second-hand's acceptable. If you do a client's washing at your home, what can you claim? Well, again, you're using your washing powder, you're using your washing machine, you're using your electricity. You would need to calculate how much it costs you to do the wash. Now that's not an easy thing to do, but you would need to estimate the wear and tear on your washing machine. I mean, one way of doing it would be to go to a laundromat and see how much it costs to do a load of laundry at a laundromat, and then base your claim on that same cost. But definitely you would be entitled to a deduction because you're probably being paid by your client for doing it, and that would be part of your assessable income. Has this been recorded and downloadable later? Yes, it will be. It'll be on YouTube probably sometime tomorrow. Just saw the other question. Right. We provide short-term accommodation. So to confirm that everything we provide in that 24-hour period relating to the client's needs is a tax deduction, food, activities, accommodation. Yes, it would be, because the amount that you charge the client is your assessable income. You then need to deduct from that your expenses, your outgoings that relate to you providing that service. That would include food, it would include electricity costs, depreciation on things like the bed, on furniture. A whole range of items go into you being able to provide that accommodation. So yes, it would be. Now, if your client said, look, I want to have a round of golf, if you went and paid for the green fees at a golf club, would that be deductible? Well, it may well be, because you would probably include the price of golf in the amount that you would charge the client. So again, it's all relative to what you what services you're providing and how it relates to those services. Question about public liability: is this a taxable offset? Well, paying for your public liability insurance would be a tax deduction. Yes, because without it, you're at risk of losing your own personal assets if you didn't have insurance. So yes, clearly deductible. How long can you employ a contractor, fee for service with their own ABN until they need to be treated as an employee rather than a contractor? I think the answer to that is not so much how long. I mean, I think you're probably thinking in terms of if you're employed as a casual for some organisations for more than a year or 2 years, you have to be made a permanent employee. I think the true test here is whether they are in fact a genuine contractor and not an employee. Now, what that means is when you look at the law relating to this, it says, you know, one of the ways to show that you're a contractor is not only having an ABN, but also having your own equipment, being able to dictate what hours you're working, providing a service as opposed to being employed for doing your services that are part of the business. Now, I mean, one of the sort of normal examples is where you employ someone with IT skills to perhaps do some programming. Now, the best way to show that they're a contractor, not an employee, is that you would then be saying, this is the job I want done, this is the amount I'm going to pay you, this is the time period I need it within the next 2 months, and that person would then have their own computers, would come in different hours and provide those services. So look, it's not a black and white area. It depends very much on the type of work, but I would suggest that if you're interested in this a bit more, let the tax clinic know and we'll send you out some written information on it. What expenses can't or can a sole trader claim that directly relates to the services they provide? For example, if the worker has a meal at a cafe or sees a movie at the cinema as part of the service to the participant, well, yes, that would be deductible if it was part of the services that you're providing. So if you take your client out for a meal and the movies, is that built into the amount that you charge? If it's something that is normally part of the service you provide, then it would be deductible. I mean, you can't take someone out for an outing somewhere and not buy them a drink or not to do something. So absolutely. It's an expense that you incur in earning your income. If you didn't do that, then you wouldn't be engaged to provide those services. Can I use my home address or office to register my ABN? Absolutely. There is no restriction in Australia on you working from home. The only thing that does create problems, and I think it's in the minds of people, if you had a business where there were going to be 5 cars parked outside your house every day from 9 till 6 at night, then your neighbours might complain to the local council and that would create a problem. They would then say, can you make sure the cars are off the road? But everyone has the right to work from home. Obviously, if you were setting up a business that was going to make steel pipes and you were going to have lots of noise and you were going to have lots of polluting chemicals or inputs into your business, then again, you wouldn't be able to do that from a residential home. But provided it's the sort of work that is not noisy, it's not going to create problems for your neighbours, then absolutely. And of course, with the coronavirus, we're all working from home. Absolutely no problems at all with that. Now, the next question. The first webinar topic was on do I need to lodge a tax return? It's available on YouTube. The PowerPoint slides we can send to you if that's of any benefit. And we only need to just let the tax clinic know and we'll send them to you. Now, travel from, okay, so if we charge a client for travel, does that then become income taxable? Absolutely, absolutely. So whatever you receive from a client is your assessable income. And then it's up to you to make sure you claim a deduction for the cost of providing that, that travel. So again, it would be cents per kilometre or the logbook method, but yes, you definitely must claim a deduction for the actual cost. But the amount that you charge the client definitely is part of your assessable income. And then the other one, I just want to confirm, travel from home to a client and return is deductible. Yes, it is, because your home is in fact your office. So unlike someone who works for a big bank in the city, they travel from home to the bank where they start their work. That's not deductible. You're actually traveling from your office, your business premises. So in that case, the expense is deductible. Would be a different story if you were working out of an office in the city. The travel from home to the office wouldn't be deductible, but clearly in your case, yes, it is. And now, what about your own meals and entry tickets? If you have to be there to attend a movie, absolutely deductible. You can't let your client just go in on their own. If they're having something to eat, there's no reason why you shouldn't. So yes, all you would do is keep the receipt in case you were asked, and that's highly unlikely. But definitely, yes, entry tickets, etc. And finally, Jenny says, thank you. Well, that's very kind. And, oh no, we've still got two more. So I'm starting as a sole trader. How can I find a client? What are the marketing techniques? Well, that's a very difficult question for me. But look, you could use social media for it. You could put an advertisement into a journal or news, magazine that's designed for the NDIS disability sector. But those expenses would be deductible. And that, I think, is the last. Thank you, Lauren. Employee or contractor. Look, it is such a difficult question. I think the best way to answer it is if you let us know at the tax clinic, we'll provide you with some written answer to that question. But if you just provide us the context, we can then be more specific in our answer. But can I just add this, that I think today we have people who are asked to be a contractor when in reality they're really an employee, but the employer wants to save money on superannuation, on workers' compensation insurance, on annual leave, sick leave. So they say to someone who in reality should be treated as an employee, will you please go and get an ABN, and that way we can treat you as a contractor. But there are some very specific things that do differentiate between employee and contractor, and simply requiring someone to get an ABN is not really sufficient. But the practical, realistic side of work is tends to make it very blurred. Now, where can I go from today? I crept in. Look, we will be putting this recording on YouTube. So if you were to go to YouTube probably later tomorrow and click and type in Tax Clinic, University of Tasmania, you'll see that this is available. Or if you want the PowerPoint slides, let the Tax Clinic know, send an email to the Tax Clinic and we'll send them to you. Now that's probably it, I think. We've been going for an hour and 15 minutes. I didn't want to go for too long so that people were getting a bit sick of it. And if anything comes out of this where you want us to put on a more specific webinar about it, then just let us know and we'll do that for you. Okay. Now, hang on, there's one more. Thank you for that, Jenny. And okay, perfect, good. Thank you very much. And we're available anytime you want. Thank you.
Thank you, everyone. Have a great evening.
Okay. Good. Thank you, Andrew. Good.